I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi there, I'm JB. In this video, I'll run Disney through my valuation sheet and determine if it's time to put Disney back in the portfolio again. I used to have Disney in my portfolio back in 2017, I believe. As I remember, I paid around $100 a share, and if I remember correct, I sold at around $150. This turned out to be almost perfect timing. I actually used to believe that Disney was a bulletproof company. But back then, I realized that Disney could stumble just like all other companies can. And when that happens to a great company, it's typical either a buying opportunity or time to sell. So, here we are again. Is this another buying opportunity, or is Disney a value trap? Well, let's look at the story and the hard facts and numbers. First, let's look at how Disney makes money and who the competition is, etc. Disney actually breaks down their revenue streams in 4 parts: media and entertainment, which is around $40 billion in revenue. This accounts for 46%. Parks, experiences, and products, which is around little bit over 32 billion, which is 37%. Sports, with a bit over 17 billion, that's 19%. And content and licensing, which cost around 1.4 billion, so minus 2%. Giving us almost a total 89 billion in revenue for 2023. If we then look at the geographic distribution, it was almost the same as 2022. Around 80% in domestic sales, almost 9% in Europe, and almost 7% in Asia Pacific. The major competition, at least on the streaming part, is companies like Netflix and Warner Brothers. Disney had an end-of-year push for Disney Plus subscriptions. Heck, even a cheapskate like me bought one. I bought the 1-year subscription for Disney Premium Plus. And that is saying a lot, because I really don't like spending money on much. So that was a big deal. Well, I also bought the 1-year subscription as a Christmas present for the family, so everyone could see their favorite content. And I was also trying to see what the product was like. If I was to invest again, I at least should see how one of the company's product and if it was any good. My first impressions are that the amount of content is not fantastic, but luckily the quality is good and most of it caters to my and my kids' tastes. Especially the science fiction parts with the Marvel content and the Star Wars, not to mention the Pixar and Disney catalog for the kids. And when the subscription is 40% off, that's value for money. Am I gonna continue my subscription after that 1 year? No, probably not. If you're a consumer of Disney, it might feel like everything is business as usual. The parks are great, the content, the streaming is good, everything looks fine. But if you're a shareholder, you probably know that there's a lot going on behind the scenes. Between the Hollywood writers and actors strikes, the cash-burning streaming services, the decline of cable, and more, Disney's business faces major hurdles. Oh yeah, there's still magic happening at Disney, at least in the parks, and strong reasons to think that they could emerge from this as a greater company, but let's be careful. Although I really like the fact that Disney listened to the public and stopped the release of the stupid woke remake of Snow White. Actually, they shouldn't have started their mindless catering to the woke mob in the first place, but hey, so did a lot of other companies. Disney has great potential. Disney is one of the largest entertainment companies in the world, and it's not going to change anytime soon. They have a formidable operating model that begins with creative teams churning out popular characters and franchises. This intellectual property is then used as a basis for a range of additional assets, more content, toys, other products, theme park rides, and more. This pulls the customer further into the Disney ecosystem and expands the revenue-generating cycle. That's why Disney is almost synonymous with entertainment, although many consumers may not even realize that Disney actually dominates at the box office. Disney owns several film production studios that operate under other names. Among those are 20th Century, and Pixar. So far this year, Disney Studios delivered 4 out of the top 10 highest grossing films, and in the most recent years, its share of the top 10 has been at least that high and often higher. But Disney also has an absolute dominance in theme parks. There is little competition for those kind of real experiences that Disney offer. And now all over the world. Between its huge parks and the Disney-owned experiences that no one else have. After the complete shutdown during the pandemic, Disney parks have reopened to huge success. Demand has soared, and this is driving sales really high. In 2023, parks segment revenue increased 13% year over year, and operating income increased 11%. The new old CEO Bob Iger recently announced that Disney is going to invest around $60 billion in the parks, and considering its current challenges, that seems like the right idea. It's putting its money in the strongest differentiating segment, which has shown over decades that it can connect with customers and drive the business higher. This will provide growth for years to come. But there are still issues. With a company of that size and breadth, there will always be some parts that do well and some parts that don't. Right now, Disney is experiencing several problems at once. The combination of these threatens to weigh down the whole operation. The rise of the streaming market looked like an incredible tailwind for the company when Disney Plus premiered right before the pandemic. But now that it has captured a good chunk of the market, management is trying to pivot its streaming business from growth to profit. This year there was a $2.6 billion loss in that part, and the only good part is that last year that was $4 billion. So it's going the right way. But still, there's a long way to go, and costs need to be cut. Also, Disney is raising prices for 2024 to get more profitable. Let's see if that makes people drop Disney Plus or not. And with all the competition also fighting for the same customers, we'll see what happens next. Traditional linear television is suffering as advertisers gradually move more of their marketing budgets to ad-supporting streaming networks and digital content. Disney might eventually have to sell some of these assets, such as the ABC television network or maybe a part of the ESPN sports channel. And let's not forget that the recently ended writer's strike and actors' strike, these have slowed production and stopped the creative activities for film studios, and those impacts could stay for some time. It is likely that Disney will get its act together soon and return to delivering higher revenues and profits, and they also promise to reinstate the dividend. Disney stock could look like a tempting buy at this low price. These are the lowest prices in a decade, and dollar cost averaging is always a good idea. Now, let's look at my valuation sheet and the hard numbers. I won't be going through every metric individually. If you want an explanation of each one and how I use them, please see the long video where I explain how I use the individual metrics. In these videos, I'm trying to keep them below 15 minutes out of respect of your time. Revenue. Revenue has been doing nicely. However, Disney has been buying that revenue. As we can see here in the earnings report, 2020 was a bad year for everyone with physical locations for income, and Disney parks usually account for 30% of the income. Here we also see why Charlie Munger calls EBITDA for bullshit earnings, as EBITDA looks nice, even though we know that actual cash coming in wasn't great. I believe Bob Iger is the man who can turn that ship around and get Disney back to 2018 levels, and hopefully giving investors the ROI of at least 15 to 16% we want. Disney's revenue and earnings score in my valuation sheet is a good 66.67%, only ruined by the 5-year revenue growth and the 5-year EBITDA. But we all know the explanation to that, and that is not something we will see again. At least I hope not. So, actually a good start. If we just take a quick look at the money coming in, aka the revenue, it doesn't look all bad, so the missing link must be in the expenses. We can see in the weighted average cost of capital versus return on invested capital The cost of capital is not great, and return on invested capital is very low, and both are going the wrong way. If we look at the profit margin, we can see that the downturn from 2020 clearly took its toll. Disney's financial strength score in my valuation sheet is really poor, with only a 25% score, especially because of the lack of cash and high debt load. The only positives are debt to EBITDA, remember? EBITDA is an easily manipulated number. And the interest coverage, meaning Disney easily can cover the interest payments on their debt. Disney's profitability and growth is an abysmal 16.67%. That's one of the lowest scores I have seen in some time. Only the operating margin growth is good and the return on capital. Everything else is miserable. The numbers don't lie, and we all know Disney has had troubles in the last years, but I still believe Disney will turn around. Although they will never be really interesting for me, too little growth potential, too low return on investment, and the dividends will probably not be high or stable enough for my dividend portfolio anytime soon. So, while we're talking dividends, let's take a quick look. We know Disney suspended the dividends back in 2020, and even if they come back in 2024, that part is a score of 0. So let's get to the real interesting part. What is a part of that company worth? At least, what I believe a share should cost. So, whoa. Hold up, wait a minute. Did you hit the like button yet? Well, could you do me a favor and hit it then? It's completely free and it really helps me a lot. Thank you. So, value metrics. None of these are really good, and the PEG ratio can't be calculated without any growth. So let's look at the intrinsic value. Book value per share is often referred to as the minimum value for a company per share, as it's the company's equity divided by the number of shares. Book value per share is right now $55.74. My EPS valuation is normally done using the current earnings per share, but here I decided to use the last 7 years' average EPS instead. Why? Well, I believe the current EPS is really not a good representation of the true value, and with the large swings in EPS, I would rather use an average than the lowest one. I know this is going to skew the result a little, but I really have a good feeling about that. As growth rate, I use the 5-year average, which is 11.47% for the first 5 years and 10% after that. Granted, Disney could grow faster, but when looking at 10-year, I think it's pretty spot on. My minimum rate of return is 10%. Here I could use the risk-free rate, but I don't mind a little risk, and I know that I can get at least 10% somewhere else, so 10 it is. For now, I set the margin of safety to 0, as I really believe these combined calculations already have the margin built in. The final PE I set at 23, which is the average over the last 23 years. So, in 2032, the share price would become around $212, and then we discount that back to today. That gives us a share price of $90.17. For my discounted cash flow valuation, I use the same growth rates and the same PE, giving us a share price of $65.20. My modified Graham number gives us a price of $116.64. My modified Peter Lynch fair value gives us a price of $60. And for good measure, I also use the Guru Focus fair value. Not the one they write on their webpage though, but the one I can calculate with their EPS valuation. Adding all these up and finding the average, we get a share price, or should we call it a medium share price, of $76.72 per share. At the making of this video, the share price was $94 per share. So, is a share price of around $77 a fair price? I would argue that's a bit at the low end. Well, Disney almost hit that price twice in October, and one could argue that any price below $80 is a fair price. Is Disney a buy?
I'd buy that for $1.
Well, not for me. There is not the growth potential I want for my portfolios. The dividends will resume in 2024, but I don't think they will be very high, and there's always a risk that Disney will suspend dividends again. If you like the company and the story, be my guest, but I don't invest in companies because of sentimentals, I invest because of fundamentals, and I don't see that here. So Disney is not a fit for any of my portfolios. But what do you think? Let me know in the comments. On that note, I will end the video. And remember, the best investment you can do is in you. The more you learn, the more you earn. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting. Living